Price doesn't speak to you with words. Instead, it communicates through the hidden body language of market movements, a repeating rhythm of shapes that reveal exactly what buyers and sellers are planning. Amateurs scan these charts looking for random shapes to gamble on. Professionals use them to build a strict, repeatable operating plan. By the end of this, you will have a complete framework. You'll know exactly when to enter a position, where to take your profits, and how to counterattack if the market tries to get table. You don't need complex algorithms or expensive software to do this. You only need a price chart and a horizontal line. This is the step where you stop guessing at directions and start executing a strategy. Step 1 is diagnosing the current psychological state of the market. We have to determine if the trend is exhausted or if it is simply resting. Let's look at exhaustion first. We call these reversal patterns. Think of a car moving fast, applying the brakes, and preparing to turn around. This chart shows a classic reversal setup, the head and shoulders. Notice the 3 distinct peaks. Buyers make a massive push, forming the head, but their next attempt, the right shoulder, fails to reach that height. Buyers lose strength, and sellers take control. The second category is the continuation pattern. Here, the market is catching its breath. It pauses to consolidate before surging forward again in the original direction. This diagram illustrates bull and bear flags, which perfectly represent a resting market. You have a strong, aggressive vertical move, the flagpole, followed by a slow, tightly contained resting period inside the flag. Categorizing the setup correctly ensures you trade alongside the momentum, rather than getting run over by it. Now we address the most common way new traders lose money, trying to trade a pattern before it has completely finished forming. You have to cage the price. We do this by drawing a rigid boundary line, often called a neckline, that traps the market action. This chart shows an ascending triangle. Look at how the flat, blue horizontal line acts as a hard ceiling, repeatedly blocking buyers from moving higher. Your rule of engagement is absolute. Take no action until a candle physically closes beyond that boundary. Drawing lines on a chart is just the theory. Having the patience to sit out until the boundary breaks is what actually protects your capital. Getting into a trade at the right time is only half the process. Without a rigid, objective rule for taking your profits, emotion will dictate your exit. We solve this with the measured move. Think of a trading pattern like a compressed spring. The total energy built up during the compression dictates exactly how far the price will travel when it finally releases. On this cup and handle pattern, we first measure the maximum depth of the cup from rim to bottom. Take that exact distance, copy it, and stack it right on top of the breakout point. That upper level is your mathematically projected exit. The measured move removes fear and greed from the equation. It gives you a specific price point to cash out and walk away. Here is the reality of live markets. Textbook patterns will fail. A failure occurs when price breaks out, triggers everyone's buy signals, and then aggressively whipsaws in the opposite direction, trapping all the initial traders. In boxing, a feint tricks the opponent into committing their weight early, forcing them to lose balance. The market does the exact same thing. We use a specific contingency rule. A failed bearish pattern reliably creates a strong bullish move, and a failed bullish pattern creates a severe drop. A failed setup represents a violent transfer of momentum that a prepared trader can immediately exploit. You have evolved from identifying random chart shapes to wielding a complete logical system.
Paste, ticking off a list. Step 1, you categorize the trend state. Step 2, you draw the boundary and wait for a clean break. Step 3, you calculate your mathematical target. And step 4, you stay ready to counterattack if the pattern fails. Your homework is to open up any charting platform, scroll backward in time, and locate 3 historical examples of these patterns. Draw your boundaries and manually calculate the measured move for each one. See for yourself how the math aligns with historical price action. True market confidence isn't bought. You earn it by testing these rules on historical data until the execution becomes second nature.